Why employment is improving under restrictive monetary policy. Alright, let's be real. This video has been a grind. I've lost track of how many cups of coffee it took me to put this together. But here's the deal. If you've been wondering why on earth jobs are growing while interest rates are sky high, I've got answers. And let me warn you, it's not what you think. Of course, the non-farm payrolls increased 254K. That might be just an error or mediatic manipulation before the US elections. But I assume that they are okay and try logical economic explanations. Here's a quick preview. One, gig work and remote works are there growing fast. Number two, government spending is a big reason sectors like healthcare and education are holding strong. Number three, AI impact on inflation and unemployment. And fourth, and we'll also talk about why Treasury Bonds could be a smart investor mover than chasing AI stocks right now. One, gig work and remote jobs, a growing part of the economy. Think of this. If you are delivering food for Uber Eats while streaming your gaming session on Twitch, here's something interesting. As of September 2024, gig work and remote jobs are continuing to grow, while many jobs are slowing down because of higher interest rates. In fact, gig work now makes up to 25% of the workforce, with platforms like Uber Eats and TaskRabbit seeing record sign-ups. This means more people are turning to flexible jobs to keep earning. High interest rates make traditional full-time employment harder to secure. People have found new ways to make a living that don't depend on interest rates being low and companies hiring. This is part of why the job market has stayed strong even when borrowing is more expensive. Do you think this growth in gig work is a temporary response to economic conditions, or will it become something permanent? How do rising interest rates affect this trend? Let's discuss job quality in the comments. Two, the delayed effects of restrictive policy. Imagine you are watching a horror movie. You know the killer is out there, but they don't show up until the worst possible moment. That's exactly how interest rates work. The Fed raises them, but we don't feel the sucker punch until a year later when jobs starts disappearing. So yeah, the economic right now it's like that slow building suspense when you know something is coming. You just don't know how or when. Here's something you must know. The effects of high interest rates take time to fully impact the economy. Interest rates have been above 4.5% since November 2022. We are just about to see how these policies affect hiring in 2024 quarter 3 and heading to quarter 4. It can take 12 to 18 months for businesses to slow down their hiring plans. Three, monetary focus on M2 is not just about interest rates. Now let's dive a little deeper into the monetarist view. It's not just about interest rates. Monetarists like Milton Friedman believe the key to the economy is controlling the money supply M2. Right now, M2 growth is slowing down to approximately 2%, far below the monetarist optimum 4%, which is made up of 2% potential growth plus 2% targeted inflation. We should, in theory, cool the economy, but it gets tricky here. Employment is still growing in the latest report. How? Well, I think it might be because some sectors aren't as sensitive to borrowing costs, but the contention holds. This core monetary rule seems to be broken unless the future readings are seriously bad. I recall Powell said M2 doesn't really matter, but ended up decreasing it. Think of the money supply like the coins in Mario Kart. The more coins you grab, the faster your card goes. Right now, the Fed is controlling the flow of those coins, slowing things down, but even with fewer coins, some princesses, drivers like healthcare and hospitality are still zooming ahead. They are important and keep receiving more coins than other cards. Number four, labor hoarding, consumer spending, and wage growth. Resilient, but for how long? Have you felt like running on ice? Does this keep you slowing you down? That's what it feels like for a lot of workers right now. Wages are rising by 4%, but inflation is making everything more expensive. Can we wake up or will we wipe out? Even though borrowing is getting more expensive, consumer spending is still relatively strong, largely because wages are growing. In September 2024, wages increased 4%, giving people more money to spend. But core inflation remains around 3.2% and headline inflation at 2.5%. Here's the big question. Is that wage bump enough? Can we keep spending without falling behind? So far, wages help keep the economy moving, even if people aren't borrowing as much. According to the latest consumer spending report, people are cutting back on some non-essential purchases like dining out, clothing, but essential sectors including healthcare and some services continue to see a steady demand and job growth. Another argument, jobs are staying strong, might be because of labor hoarding. Companies are holding onto workers, fearing that finding skilled labor later on can be harder. So firms don't want to cut staff even if demand slows. But the big question is, how long can this last? As prices continue to rise, wage growth might not be enough to keep up, especially if more sectors start feeling the squeeze from high borrowing costs. The Keynesians and the US versus the UK, a tale of two education sectors. Here's a stark contrast. Not all countries are experiencing the same trends. In the US, government spending or federal funding has helped keep sectors like education and public services afloat. The education sector is facing cuts, leading to job losses. Keynesians will argue that this is exactly what explains the resilience of the job market. By spending in areas like education and healthcare, the government is keeping employment strong, even when borrowing is tough. This is a reminder that fiscal policy, as in the Keynesian, plays a huge role in whether sectors survive or struggle. Recently, markets punished fiscal overspending in the UK, but why does the US seem to be immune to a debt crisis so far? Will this last many more quarters or years? The fact is, the Fed and everyone agrees that the debt path is just unsustainable. At first glance, government spending looks essential to keeping jobs in sectors like education under restricted interest rates. AI impact on white collar versus blue collar jobs. AI is taking over both blue collar and white collar jobs, but not at the same rate. For blue collar jobs, AI and automation are quickly replacing tasks that are repetitive, like in factories or warehouses. Robots are great at doing the same thing over and over again, faster and cheaper. Do you think AI driving productivity is offsetting job losses caused by restrictive policies? Or is it adding pressure to an already tight labor market? Sure, AI is replacing some jobs, but it's also creating opportunities in areas like AI development and maintenance. The question is, will these new jobs offset the ones being lost? On the other hand, white collar jobs are being impacted in a different way. AI is taking over tasks like data analysis, financial reporting, and even writing. It's handling some of the more routine tasks that people used to do in offices. So, while both types of jobs are affected, the impact isn't happening equally. Blue collar jobs are more at risk of being replaced altogether, whereas many white collar workers might see their jobs change rather than disappear. 7. Real business cycle theory, AI and jobless growth. Jobless growth sounds weird, right? But with AI making the economy more productive, companies can produce more with fewer workers. This could lead to jobless growth, where the economy grows but employment doesn't keep pace. We might see higher GDP because of AI, but fewer people working, which raises a big question. Who will buy all these products if more people lose their jobs? Just in like in the film The Matrix, the system keeps growing, but what happens when people get forcibly disconnected? Will this matter to indebted countries? 8. The Fed's dilemma, balancing inflation and job growth. This gets trickier and brings us back to the Fed's dilemma. Picture the Fed as a tightrope walker. The Fed's job is to balance inflation with job growth. If they keep interest rates high to say something above 3% or 3.5%, inflation stays under control. But we could eventually see more job losses. But if they cut rates too soon, people might start spending too much, and inflation could spike again. The challenge is even tougher now because of AI and technology. AI is boosting productivity, which is good for the economy, but it's also changing the way people work. So the Fed has to figure it out how to control inflation without holding back to job growth too much. 9. How this affected my bond and stock shopping list. This is what I have done, and make sure you understand it is not financial advice. I might be totally wrong. With AI stocks potentially overextended, the safe and stable yields offered by Treasury Bonds, especially in this high interest rate environment, could provide better long-term returns with lower risk. I personally favor TLT, an ETF focused on long duration treasuries for my portfolio. These bonds are performing well, especially during economic uncertainty. If you are concerned about inflation, tips: Treasury inflation protected securities offer additional security. All right, let's sum it up all up. Labor hoarding is keeping more people employed, at least for now. 2. Gig work and remote jobs are expanding, giving people more options to earn money. 3. Some sectors like healthcare and services aren't as sensitive to borrowing costs, so they are still hiring. 4. AI and technology are making companies more productive, but that also means jobs might disappear over time. Despite all the odds, jobs are still growing even with high interest rates. But can this balance really last? As AI reshapes the economy and the Fed keeps fighting inflation, what happens next could change everything. Let's see how these forces plays out in the months to come. Thanks for watching. If you want to learn more about how the economy works and how it affects our daily lives, make sure to hit that subscribe button. Drop a comment if you have any questions or want to know more about the job market or AI. See you in my next video.